The impact of Silicon Valley bank failure and other bank failures like Credit Suisse on your stack. Stay tuned for this urgent update.
We're going to break down the Silicon Valley bank and Credit Suisse bank crises on 3 levels and tell you what the impact will be on stackers.
That's right. And with each level, we're going to dive deeper in and add complexity, so hold on tight. But for those of you who just want to skip to the conclusion, feel free. It's going to be, we'll put the time up, it'll be right here, okay? So just go to this timestamp and you'll get the conclusion. You don't have to deal with all the faffery and buffoonery. Okay, level 1, let's get started. Modern bank runs demonstrate what most in the stacking community have known or suspected all along. The modern banking system is fundamentally insolvent, and cracks having already appeared previously have now begun getting wider. As Yankee Stacking says, be your own bank. And really, that's it. It's that simple. This is just more proof, it's an iteration of things that have happened many times in the past in many different cultures and civilizations, and it's happening right now.
When you have the Federal Reserve or various presidential administrations distributing huge amounts of cash to individual citizens, society and the financial institutions are always, I feel like, very, very delicate, and that's just, I don't know that we can withstand that kind of, inflation.
That disequilibrium, cash goes all the way up, cash goes all the way down. We saw it go all the way up, and now we're starting to see it go down, and that's bad for banks, right? Okay, now let's get to the next level, level 2. All right, over the past 2 years, U.S. banks have been buying up lots of U.S. Treasuries. U.S. Treasuries are used by banks as collateral in what's known as the Basel III system.
They have to do that.
They have to, right? Well, they have to have different types of collateral, and they can loan larger amounts against what are called top tier or tier 1 collateral. So the better quality your collateral is, according to the system, the more dollars you can lend out per dollar you have invested in that collateral. Gold, by the way, is also tier 1. I think is
it's probably the only actual tier 1, because
right,
I feel like the idea that bonds are tier 1 is part of the problem.
Oh, it's completely ridiculous. But anyway, so they went out and they bought a lot of U.S. Treasuries because Treasuries are tier 1 collateral according to the Basel III banking system. And especially what they did is they bought up a lot of short-term Treasuries, right? And that's a problem because short-term Treasuries were being bought up by the Fed.
The price of those are actively being manipulated by the Federal
Reserve.
Well,
first they were manipulated down, that is, yields were driven down, the bond price was driven up by the Fed.
Which is good for a tier 1 investment.
Right. So the banks followed along. They also bought a lot of that short-term paper, the short-term U.S. Treasuries. The problem is the Fed said very clearly ahead of time, we're going to sell off a lot of those. And more technically, what they're doing is they were refusing to buy more of them. And because of that, the yields on the short-term U.S. Treasuries have gone up, and therefore the bond values have gone down, right? Now, what's important here is
they have to hold those bonds to maturity since they've lost so much in value, right?
Right, exactly.
The banks can't sell them like they used to, just at market value, as the share or the bond price was either stable or increasing with Federal Reserve purchasing of bonds.
Right. So
now they're going down in price, so they can't sell them, right?
Exactly. They went out and they bought a lot of treasuries at low rates and high bond prices compared to par. And
low yield, high price.
Yeah, and now the yields have gone up, the price has gone down, and those bonds are worth 60, 70, 80 cents on the dollar if they had to be sold today. If they could be held to maturity, they'll hold their value. They could be the bank can just hold it and collect the premium at the end. But because they can't hold it to maturity, because they have to sell it, if there's an influx in depositors, then they have to sell it at a loss.
Because depositors
of 20,
are pulling cash out.
Right. And that's what happened with Silicon Valley Bank. They were forced to sell off some of their loan book. And they had a bunch of long-dated paper or U.S. Treasuries, a bunch of short-dated paper or U.S. Treasuries. And their short-term U.S. Treasuries had fallen a lot in value. Their longer-term dated U.S. Treasuries, the 10 and 20-year, had fallen less in value because the short-term rates had risen a lot. As the yield curve inverted, the short-term rates were raised a lot higher, and the longer-term rates were raised less. So they sold off initially a lot of their 10 and 20-year paper at lesser losses, but then ultimately were forced to capitulate because once they started looking to sell the short-term paper, they'd already lost too much and they were technically insolvent, right? So that's what happened with Silicon Valley Bank, and that's what a lot of other banks with similar positions and market capitalizations are exposed to, right?
Well, yeah, because they're all holding bonds as tier one investments. And the Federal Reserve is now actively not buying bonds because they want the yields to rise. Isn't that related to the federal funds rate?
Exactly. The federal funds rate is being determined by the Fed selling or buying or not selling or not buying short-term paper.
Like quantitative easing was because they were buying bonds.
Yep.
And that was how they kept the interest rate. Those yields came down with the price of bonds going up, and that kept the interest rate for Americans and businesses and every other entity low.
Exactly. And as Fed instituted quantitative tightening, selling off their bond portfolio, and also instituted raising the Fed interbank lending rate by selling off short-term U.S. Treasuries. That's how come, or a big reason that the short-term yields are in excess, or were shortly ago, in excess of 5%.
Okay, I have a question, and maybe people already know this, but why did banks not re-strategize their purchasing of treasury bonds? Because the Federal Reserve, to be fair, made it very clear that they were going to stop buying bonds. So everyone should have anticipated a drop in the price of bonds and therefore a yield that would go up, but the banks would be stuck buying these bonds.
Shoulda, coulda, woulda. Competence is a major factor here, and probably they're spending more time, I don't know if you saw this on the internet, filming videos than running their bank. So that's probably a reason, but you might have to ask them, and I'm sure attorneys in deposition will. Okay, so the FDIC illegally backstopped not just the depositors up to $250,000 per account, which is what they're supposed to do according to statutory law, but now they've illegally backstopped all depositors of Silicon Valley Bank. This free money giveaway is a taxpayer-funded theft, but more importantly than that, it's massively inflationary. Now they're calling it a swap line, and they're saying it has to be repaid. But as you can see with PPP loans, loans given out by most government institutions to politically connected institutions or under times of duress never have to be repaid. So I don't think that's going to happen. But it is a massive inflationary force.
See, I would have thought it would just prevent the appropriate level of deflation that would be healthy for our economy, because it's not really adding any dollars. It's just keeping the dollars that were going to be lost in the system. And
no, I think you're absolutely right. It prevents the deflation that would have occurred from Silicon Valley Bank depositors losing all their cash. Anytime you see cash go to money heaven, that's deflation. Whereas if you see it come from money hell, it's inflation. So you're right, that it's isolated by itself. You're right, that's not hugely inflationary. It just prevents a deflationary shock. But here's what's important. Every other single depositor is going to be looking at that. Every other bank's going to be looking at that. And if they see now that all of a sudden FDIC has removed all moral hazard to any kind of deposits and you can just leave money anywhere in the system, that's a massive inflationary stimulus, because it creates the incentive for banks to put money in the system, for depositors to put money in the system and keep it there.
Without any care, for like kind of a little more careless.
Right. So it feels more careless behavior. Okay.
How far can the FDIC actually, like how much can the FDIC actually do to reimburse full amounts for depositors? I mean, how long can that last?
Sure, if they have cooperation. Well, technically, they put a facility out at $25 billion, which is nothing. It's a whisper in a hurricane. So that's completely insufficient to prop up the banking system. The question really is, how much money can they get the Fed to print and the Treasuries, blessing to print? And that's a political question.
And that would be inflationary. Right?
That's massive inflation. Sure, of course. If the FDIC wants to backstop every single depositor in the United States, I think they have to come up with about $93 trillion. So they could print off $93 trillion. But what do you think will happen there? Yeah. So no, it's massively inflationary what they've done, and we're going to see the results coming through the system on that. At the same time as we see massive deflationary forces, because people are going to take their money to the bank, and that brings us to level 3.
Okay, let's just review. So the first level is that the banking system is fundamentally, you say insolvent, maybe I'd say fragile.
Okay, the modern banking system.
Modern banking system.
Run by the United States.
And then we have level 2, is that, I don't remember what level 2 was. Over the past 2 years, the U.S. Treasury has been buying up bonds.
Yeah, well, level 2 is just addressing the current bank causes of bank insolvencies, which are that short-term paper has been bought up, and then after having been bought up and suppressed, the yields suppressed very much. Now the yields are artificially unsuppressed, and the paper is artificially sold off, and that's causing banks to be unable to sell off their short-term U.S. Treasury securities to pay off depositors in cash.
Yes, okay. And level 3?
Level 3. All right, hold on tight, because level 3 gets a little complex. This trend will continue, the trend of depositors wanting to pull out cash out of these banks. And as Peter Schiff correctly pointed out in his podcast, I think about 3 days ago, banks cannot offer competitive interest rates because they lose money on the spread. What do I mean by that? What's the spread? For every dollar banks bought of U.S. short-term U.S. Treasuries, back when the U.S. Treasury yields were only 0.5%, right? They can only lend out something at or below that to depositors, right? Because they have to make money on the spread. They can't buy U.S. Treasury at 0.5% and then pay you and me a 2% deposit rate. They'll lose 1.5% every year. That'll cause them to lose a significant amount of cash, right? So low interest to depositors has prevailed in the system, not just because banks are quote unquote greedy or anything like that, but because the dollars that the banks put into investments only yielded 0.5% or so. And then therefore they can only pay out 0.25%.
Right, that's like what everyone expects. Your bank account is going to basically be almost flat. Maybe you get like 0.02 or something like that. But now,
what's different?
We were just talking about this with my own mom the other day. We were telling her, don't put your money into a bank that's just going to give you 0.2 or 0.3%.
Right.
You should just take your cash and buy 5-year Treasury bonds.
2 or 5-year Treasuries.
We were just talking about this before any of this, like last week.
That are paying off 5% interest rates. Why not get the 5% interest rate from the quote unquote most secure investment in the world?
And the most liquid, so you can sell it to the market if you need to get the cash. And instead of taking a penalty from the bank that might charge you to pull cash out early.
Oh, like a CD, for example.
Anyways, if we're talking about this, I mean, obviously we do spend a little more time thinking about finance, but we can't be, I mean, I'm sure many people realize they can take cash that they want to put into a savings account anyways and make 4%, 5% on that cash, especially during a time of inflation.
By going out and buying U.S. Treasuries or other similar higher yielding instruments.
Rather than just letting it sit in the bank, but the bank needs people to do that in order to make money on the spread. Because they're able to take those Treasury yields of 5%, give you 0.5%, and at least try to recapture some of that lost value that they, right? Is that part of it, that helps capture some of the lost value in the bond's underlying price that's gone down?
You mean if depositors go out and buy bonds? Yeah, it could. That would be a good force in terms of shoring up the collateral for banks, the U.S. Treasury collateral, if there's a big flock of investors to do that. But here's the problem. The Federal Reserve still sets the rates. So you and I can go out and buy as many bonds as we want, but the Federal Reserve can just roll more off their balance sheet. And they're working with billions and billions of dollars all the time. So if the Federal Reserve decides to sell off bonds, they're going to push yields up.
Even if everyone else is going into bonds at the same time, it's not enough to counteract.
Yep. And so as long as interest rates remain elevated, and especially with the backdrop of banks failing, there will be a flight to safety, a capital flight to safety, and to the relatively safer U.S. Treasury bills over bank accounts themselves. To keep the banking system together, the Fed will be forced to buy a paper, specifically U.S. Treasuries, and specifically short-dated U.S. Treasuries, 1, 2, and 3-year yields, for example, to bail the whole banking system out.
Yeah, because the FDIC won't be able to actually reimburse everyone. They need to keep the banking system, the structure, they need to keep the banking system intact, and the only way they can do that is propping up those bonds that are tier 1 assets that all the banks are now seeing huge losses on. And therefore, that's going to lead to basically QE again. Is that essentially what we're coming back to?
This is QE by another name, absolutely.
Which is putting us back into lower interest environments and hello gold price. Am I right?
All right, and that's where we come to our conclusion. So gold price is correlated with U.S. Treasury yields. That is, as yields go down or bonds are bought, the gold price goes up. Both are safe haven assets as well, right? Especially gold. The two actionable pieces of information are this. First, hold on tight to your stack. Don't sell unless you absolutely have to right now. And if you're already have an accumulation plan, stick to that plan. If your accumulation plan has you buying at certain times where you think there might be a run-up in price, now might be a good time to do that. I'm not making any guarantees. I'm just saying it could be. Look to continue your accumulation plan. If you have cash in a bank account and you've been sitting on cash and you've been thinking, oh, maybe I'll buy some gold with that cash, or maybe I'll just take that cash out to keep it safe. I don't know what more warning you need in this. I got to tell you, these banks, your bank is not going to send you a written invitation in the mail saying, dear sir, we are privileged to let you know that we're going to
That
shortly...
we are failing.
We're in the process of failing. I would like to invite you, our most special of customers of the...
Pull your money out now before it gets bad. They're not going to tell you.
Please RSVP.
Wait, that's what's so funny. On Wednesday, as recent as Wednesday afternoon, I read that regulators... Last Wednesday.
Yeah.
That regulators were saying that, I'm going to quote them, they said that the SV Bank was in sound financial condition. That's the words regulators. Wednesday afternoon.
Yeah.
It was Wednesday night that I think within that 24-hour period they sold $21 billion worth of bonds,
10 and 20
and they lost
notes.
$2 billion
Yep.
on the selling of them. And then the next day there was a different story. But yeah, as recent as Wednesday, regulators said this bank is in quote sound financial condition.
Yeah.
So I don't think they're going to let us know much ahead of time.
Exactly. So now's the time. If you haven't yet, if you're sitting on, especially, I'm not talking about your monthly budget. If you have your monthly budget of cash in the bank and you're using it for general banking purposes, I'm not talking about that. I'm saying if you have a major slice of cash, slug of cash, stack of cash in a bank, in excess, far in excess, especially of your monthly budget, even if it's in a CD or some other safe thing, get it out.
I just told my mom, make sure you don't have anything more than $250,000 in any one bank.
That's a problem, because here's what the FDIC is going to do with small bank runs like this, or relatively smaller ones. The FDIC can go through backstop, throw cash at the problem. Cash will take care of the problem. The problem is, what if that happens more systemically?
Well, and as they're giving more than the $250,000, doesn't that accelerate their insolvency?
Yep. Oh, so yeah, if they're bailing out all depositors, including the ones who have $300,000 or $250,000 and more, then yes, they're going to run out of cash in their fund.
I don't know that I think they ended up bailing out everyone,
yes.
Right? Because I know Roku.
They committed to it.
You know Roku, like the company. They had like $500 million in SV Bank alone. Right. Something, or maybe even $1 billion. I know it was a lot. I think it was $500 million, but don't quote me on that because I'm trying to remember.
No, it's a lot though.
And that was really sort of irresponsible of the company.
Hugely irresponsible.
But also they got bailed out completely. So that has to, you have big depositors that are getting bailed out. That's got to accelerate.
And that's exactly the thing. If there's a systemic bank run, it's the Rokus, it's the well-connected entities in the world, it's the multimillionaires who donate to the right party, the right politician. They're going to get bailed out first in front of the line. You and me are at the back of the line. Yeah. All right, so we'll all get bailed out. I really truly believe we'll all get bailed out in nominal terms.
Yeah.
Right? We'll all be made whole if we have a $10,000, let's say, in a bank, and the FDIC said, commits to, okay, fine, we'll get our $10,000 back. But that's after the billionaires already got several $1 trillion. That's after the multi-billionaire companies already got several $1 trillion. After all that money's floating around, and there's something called the Cantillon effect. The first person, the first entity to get the inflation or get the new cash, they get the benefits first. Yeah. By the time it trickles down to everybody else, to the common man, your $10,000 will buy you, I don't know, maybe it'll pay your rent for a month. Yeah. That'll be, or your mortgage. That'll be all it's good for. Well, not your mortgage if it's fixed rate, but it'll pay for a month's living expenses. So it's going to be devalued considerably. So get your money into the bank now. And you want to talk about moral hazard? And just a quick note on moral hazard here. There are a lot of people are going to say, no, don't stoke banking fears. Don't stoke this. Don't stoke that. Well, here's an idea. This system. I'm not talking to the audience, by the way. I'm talking to the government. You created this. Now it's finally come to bite you in the ass. Every single person who cares about their individual sovereignty and their financial future needs to get the.
I think we may have to edit some of this.
Maybe.
But it is true. I mean, there's manipulation of our currency. There's manipulation of the money supply, and it's always to benefit usually people who are well connected or in the right.
In the right place in the right time, yeah.
Well,
Grease in the right pond.
Maybe in the right political
orientation.
Atmosphere, but it's not fair to people who work and earn their own money and want to have savings and want to have sound finance.
Yep.
Or a sound financial system that they can participate in.
Yep. So as far as I'm concerned, this is the last warning. Get out now. Get out of the system, except to the extent you actually have to participate. But now's the time to drop out. That's it.
And it's an exciting time, I think, to be a stacker.
Oh yeah, that's for sure. That's for sure. Well, lastly, keep an eye on deflation. We'll maybe do some subsequent videos about that. But deflation is going to be a force we have to deal.
You mentioned that to me, and I see inflation being a huge problem now. I see the Federal Reserve. Everyone said, they're not going to have a soft landing. They're going to be between a rock and a hard place, which is keeping the financial system solvent and trying to stop inflation from going totally rampant. And we can see now the cracks in the financial system. We're almost certainly headed towards a serious, I don't want to say hyperinflation, but maybe, or at least, continued persistent high levels of inflation.
Yep.
So I don't see deflation at all. I'm
As
very
a teaser,
curious about
there's going to be a deflation shock, or there's a possibility of a deflation shock coming up. If you want to find out more about that, I'd strongly encourage you to go find Neil McCoy Ward. We'll put the card up here. Neil McCoy Ward, he does a series called The Depression Diaries. They're absolutely fantastic, great listening to. And it gives you an idea of what can happen when deflationary pressures hit a market. Very interesting stuff.
I mean, I can't see how that's relevant right now, but maybe we all need to check it out because I've never watched it either.
Right.
I'm
Well,
very curious.
I wanted to talk about it here, but I just wanted to focus on the necessary stuff. I didn't want to go too long.
We don't have all day today, so
Exactly.
way to just get this done quickly.
Exactly. So this is the end of the Barely Bullish Investing urgent broadcast. Stay tuned for future updates, and in the meantime, stay safe, take action as needed.
Take care.